Thank you for choosing to join us today on the Digital Insurance Agent Podcast. And with me today is Mike Jesowshek, CPA. Mike, thanks for joining us today.
Yeah, thanks for having me, Carl.
All right. Well, today we're going to be looking at several topics around taxes. And you may be going, oh my gosh, but as a business owner, taxes are one of the most important things we can talk about. But before we get into that, Mike, tell us a little bit about your story. You've got kind of an interesting story yourself, and then we'll kind of dive into some things that I think are going to be beneficial to our audience as your business grows and really what you need to be thinking about when it comes to taxes and really even how you work with your CPA.
Yeah, for sure. Thanks for having me, Carl. And yeah, so I've been an entrepreneur since the age of 14. Started my career out in the online marketing industry, and was in a few different businesses in that. Had partners, had no partners, had a couple exits, and a lot of failures as well in between there. But eventually ended up going to school as a backup plan to say, hey, if this whole thing doesn't work out, at least I have a backup plan. And got a degree in accounting, got my CPA, and started to work on the finance side of these businesses. And eventually got to a point where we had 7 partners in one of our companies, and we were all really good at different things. And we were trying to pull this company into 7 different directions. And so instead of trying to pull that company that way, we said, why don't we all just go out and do what we're best at? And so at that point in time, I started a digital accounting firm back in 2013, and started to build that up, but wasn't doing any kind of tax prep, tax planning items, and started to see some of the struggles that business owners had when it came to taxes, not understanding tax opportunities that were available to them. And that eventually set me out on a mission to say, how can I help business owners understand the tax strategies available to them? First, I have to figure it out for myself because I was struggling with the same thing, and really fell in love with this idea of tax planning, tax strategy. Ended up starting a podcast by accident, and with the sole purpose of teaching business owners the strategies available to them, and fell in love with teaching to the masses. Sold the majority stake in my firm back in 2021, and have been full time on podcasting and teaching on tax strategies to small business owners ever since.
Fantastic. So you bring up something really important, and this is really where we'll start off, and that is the difference between tax planning versus tax preparation. Because a lot of small business owners think that their CPA, quote unquote, does taxes. So can you explain the real difference between tax preparation and tax planning?
Yeah, so tax preparation and just definition idea behind it, because when most people hear the word tax, they think, okay, I see my accountant beginning of the year, give them my information, and they file my return, and then I don't see them again till the beginning of next year. And that's just tax filing. That's tax preparation, and tax preparation is important. It's required by law. It needs to be done. But all that is doing is taking information and sending it up to the government agencies. So we're telling the federal government, we're telling the state government, here's the type of income I had, here's the different income expenses in my business, and here's just information that we're sending to them. That's it. We're not saving taxes when we do tax preparation and filing. We're simply sending information up. And again, it's required by law. But the thing that comes before that, the thing that needs to be done for the most part between January and December, is this concept of tax planning. And this concept of tax planning is saying, okay, what strategies are available to me as a business owner, as a real estate investor, whatever we might be in, but what tax strategies are available to me, and then how am I going to implement them in my business to actually see tax saving results? So I always say tax planning is done January through December, and tax preparation and filing is done at the beginning of the year. And I think so many business owners think that, yeah, my accountant does tax planning with me, right? Because they file my return, and then they reach out every quarter and say, you need to make a payment for this amount and this amount and this amount. And that's tax planning, because now I'm making estimated tax payments. And while that is sort of planning for the eventual tax filing, that's all it is. It's planning for that tax prep. And so, of course, that's important to make estimated tax payments, but that's not what we're talking about when we talk about tax planning. And I know we're going to kind of dive into different strategies, but tax planning is saying, okay, what's available to me as a tax strategy, and then putting that in practice. And then when we do that filing at the end of the year, we're seeing the results of that work we put in on the planning side.
Absolutely. So, Mike, what are some examples of just some tax savings that often are missed by those who just simply focus on tax preparation?
Yeah, there's all different realms of it. It often starts with what type of entity structure do we have up? So, do we have the most tax efficient entity structure for our business? Whether we're on our own or we have partners, whether we have multiple businesses, do we have the right entity structure that's going to be tax efficient for us? That's a planning piece. Oftentimes, it's looking at deductions. What deductions are available to us, and a lot of times people don't think about the type of deductions available. I talk all the time to people that used to be W-2 workers, and if it's a contractor or something like that, they used to be a W-2 worker, and now they're coming to, they're either going out on their own or for some reason they move to a 1099 contractor. Maybe they're working with multiple different people now. And they just assume I was a W-2 worker. I couldn't take deductions then. So now I'm a 1099 contractor and I'm not going to take deductions now. Whatever I makes my income. But they're forgetting about so many opportunities that are sitting out there where it's not spending money. It's just taking the spending that we're already doing and rerouting it into our business. And then, we even could talk about retirement plans and how different ways of saving into a retirement account can be tax efficient or non-tax efficient, and in making sure that we're making the best decision there. So there's a lot of different buckets of different types of strategies we start to look at. And it's just kind of creating the perfect combination of all those.
Yeah, and you brought up, this entity selection process, and that's really the foundation. So, how important is it to choose the right entity early on, and really how does that impact taxes?
Yeah, for the most, it's really important, and so there's a legal aspect to an entity structure, and then there's a tax aspect as well, right? And so, for most small business owners, we're seeing them either as a sole proprietorship, an LLC, very unlikely a C corporation, but then also we often see an S corporation, and an S corporation is not an entity type; it's simply a tax election, and it's a strategy that we often see to help small business owners pay less in self-employment taxes. And so what I always tell business owners is that if we think of this idea of an S corporation, we don't want to do it before it needs to be done. So we don't want to rush into an S corporation. But in order to have an S corporation, we need to have a foundation of an LLC or a corporation that we can elect S corp status on. And so when I'm talking to small business owners, what I typically say is once you start to have an idea, once you start to actually start a business, now we need to look at having a really good entity structure set up. And of course, there's the legal aspect I think is super important as well. But having a sole proprietorship with an active running business can provide legal issues, and it also provides no protection or no ability to look at an S corporation when and if it makes sense in your business. So I typically like to see people organize an LLC again once they have a proven business that they've started. To organize an LLC, we might not do an S corp status right away, but we have an LLC for that liability protection. But it also serves as sort of an insurance policy for an S corporation when and if that makes sense in our business.
Yeah, so listening to what you're saying here, Mike, sounds like we need to be revisiting our structure along the way. And how often would you say that a business owner needs to be revisiting that structure to make sure it's appropriate? Is there kind of a frequency you suggest, or how do they make that evaluation?
Yeah, so typically what I say is once we have that foundation of an LLC set up in our business, now we're looking at do we upgrade to an S corporation? And is there a point in time we look to an S corporation? We typically say once we start to see profit of $50,000, $60,000 or more, we want to at least start to entertain this idea of electing S corp status on that LLC. So this can be a once a year thing, but also something we keep in the back of our mind. I like to do a mid to kind of third quarter checkup to say, if we're organized as an LLC, does it make sense now? What's our profit going to look like? Does it make sense that maybe we want to backdate an S corporation to January 1st to become an S corporation for this entire year? So that's kind of a piece that you want to look at. So I typically recommend looking at that in mid-year, do a check, and then Q3 going into Q4, do another check on that. And then the other aspect is once we start other businesses. So maybe we have one business that we're operating. Now we have a secondary location or a secondary business that we're going to add on to that. We want to revisit our entity structure. Or if we have a business that we are adding a partner in or a separate business with a partner, we want to make sure that we're looking at the best entity structure so that it's tax efficient across the board for us. Because so many people, especially as entrepreneurs, we start businesses and then we start other businesses, and eventually we have 3, 4 businesses going, and the entity structure is not in the most tax efficient matter. So any time that we're looking to bring on a new revenue line, bring on a new business, bring on a new partner, that is definitely a point in time that we should be revisiting that entity selection piece of our business.
Good. Now, as we, get our things lined up, of course, deductions are going to be one of the things we're looking at. And you talk about pre-tax versus after-tax spending. Can you break down the difference between those and then how that's going to impact businesses' cash flow?
Yeah, the best way to describe this concept, and I often talk about this idea of maximizing deductions. And normally when I tell a room of small business owners that you should be thinking about maximizing deductions, they instantly think of, oh yeah, like my accountant tells me to go buy a truck that I don't really need, but it's going to be a tax benefit, or my accountant goes and tells me to, purchase these things to get that tax benefit. And that's not what I'm talking about when I talk about maximizing deductions. I'm talking about this concept of pre-tax versus after-tax spending. And the best way to describe it is imagine that you're a W-2 worker. You have your gross wages, and then your employer takes all these taxes out, and then you get whatever your net pay is or your take-home pay is, and that's what gets deposited into your bank account. And any spending that you do with that take-home pay is money that's already been taxed. Those taxes have already been pulled out. So I call that after-tax spending. But as a business owner, we have a flip side. We have our sales or our revenue, and then we have all these expenses that go into our business, and then we're left with a profit. And that profit is what we get taxed on. So any spending that we do inside of our business is considered pre-tax spending. It's spending that's being done prior to those funds being taxed. And so I often talk to business owners and I say, okay, instead of thinking about buying things that we don't need to get a tax deduction for, what if we look for ways that we can shift spending that we're already doing, but instead of using after-tax spending, now we can use pre-tax spending to get that deduction for it.
Good. And then what are some deductions that most small business owners might be missing that are kind of surprises that most people might not be aware of?
Yeah, so when we look back at that after-tax versus pre-tax spending, a really good example of that's like, let's look at the home office. You're going to live in a home whether you're a business owner or not. And so you're going to have those costs for that home either way. And so instead of using after-tax spending on a 100% of that home cost, why don't we take the home office deduction and at least get, maybe it's 5%, 10%, 15% of those costs? Now we're getting as a business deduction. That's simply taking money from after-tax spending and moving it into pre-tax spending. We could look at automobile and taking mileage or actual expenses of business use of an automobile. Maybe we're looking at meals or travel. We see this all the time. Me and my wife used to do this a lot, especially before we had kids, is we would say, hey, we're looking to check out this new city. Maybe it's Washington, D.C., and we want to go there. We want to explore. We want to check out the restaurants and go to the memorials and all those fun things. But what if we could tie a business purpose to going to Washington, D.C.? Maybe that is attending a conference out there. And so we're going to spend at least more than half the day at that conference. But after that conference is over, the IRS doesn't care what we do. If we go explore the city, go to the restaurant, that's considered a business day as long as the majority of that day was spent on business related items. So we would oftentimes plan places that we wanted to go anyways around a business conference, or maybe a vendor that we were going to meet up with, or a client that we were going to consult with in person. So that's the type of idea where we're taking a place we want to go personally. We're going to do it anyways, but now we're moving it from after-tax spending into pre-tax spending. And there's things like setting up a board and hiring your kids and taking health insurance premium deductions, and in all of those, again, just kind of reiterate this concept of this is spending that I'm going to do whether I'm a business owner or not, but now I'm finding a business purpose for it, getting a business deduction for it, and moving it from after-tax spending into pre-tax spending. That is so much better, more tax efficient than saying, I'm going to go buy a piece of equipment I don't need, or I'm going to go buy a new computer just to get that tax deduction and lower my income this year. This is a completely different way to look at that.
I think that's great, and I love what you're saying, Mike. So often we hear that story. The accountant says, "Go buy this depreciating asset,"
Mm.
and so you're giving some ideas here. So let's dive into a couple of those. Number one is setting up a board for your business. So let's talk about that. So for a solo entrepreneur or a small team, what does that look like to set up a board?
Yeah, I think this one sometimes comes to a surprise because when someone thinks board, they think, Apple's boards meeting or, this big company, they're having their board meetings. And I always say that every business, regardless of size, whether you're just a solo business with no employees, no other owners, just you yourself, you should still have a board in your business. And there's multiple reasons on why we look at a board. But one of them is for tax purposes, of course. So whenever we host board meetings, now we have meals around that board meeting. We have travel potentially related to that board meeting, and those are all costs that we can take as a deduction. But that process of setting up a board is just determining who around you would you want to help advise in your business. Is there family members? Is there friends? Is there close colleagues that you think could bring some really good insights to your business? And again, this doesn't have to be a massive, massive company. You could be a solo consultant and that's your only income, and you can still have a board that can just help you from time to time step back and look at different opportunities in your business. So there's definitely the tax aspect, meals, travel, those types of items related to it. But then there's non-tax aspects to it too. You look at a mentor, you be able to step away from your business. Carl, I can imagine you can relate to this too as a business owner. Sometimes it gets lonely, right? Like you're the one running the shop. There's no one to bounce ideas off of. When you have a rough day, especially if you're solo, there's no one that we can ask for advice from. When you have a board set up, it's preset time. It's a preset group of people that allows you to step away from your business and step away from your business in a good way by looking at it instead of being deep in the weeds. Let's look at it from a high level. Not only that, I think it's super helpful to be held accountable. So if I'm talking with my board and saying, "Hey, I've really been thinking about putting this marketing campaign in place," or I've really been thinking about doing some of these tax strategy, we can talk through it as a board, and then I can say, "Okay, by the time we come to our next board meeting, whether that's monthly, quarterly, whatever it might be, by the time I come to my next board meeting, I want to have one, two, or three things to show to you." Well, as a business owner, sometimes we're not held accountable because there's no one above us. We don't have a boss. But now this provides sort of that accountability line of chain that we can say, "Hey, I know that next board meeting, I got to report back on whatever it said I was going to do." And so that's keeping me accountable to get those things done.
Yeah, I think that's great advice, Mike. Just beyond the tax implications, just the personal development, the personal growth for you as a leader, you as an entrepreneur, is phenomenal. Now, you also brought up hiring your kids, and for a lot of business owners, that's one of the reasons they started a business. They wanted more time with family, and so bringing their kids into the business and creating a legacy piece is part of their motivation. So let's talk a little bit about that. When you hire your children in your business, how does that actually work? And why can this be a smart tax move for you?
Yeah, as you kind of mentioned, there's this is the same as the board. There's tax advantages and there's non-tax advantages to it. But when we look at it from a tax aspect, the cool thing is that anybody, if their earned income is underneath the standard deduction, which is right around $15,000 this year, if their earned income is under $15,000, they don't pay any federal income taxes. And the IRS actually has a piece directly in the tax code that says if you hire your children under the age of 18 in your business and you operate as a sole proprietor, you don't have to withhold for Social Security or Medicare taxes, aka FICA taxes, for the payments to them. And so what that means is that we could hire our kids. Let's say it's $5,000, $10,000 a year, whatever it might be for what they're doing. But we could hire our kids in our business. We get a business deduction for it, and they pay no income taxes. They don't pay FICA taxes because they're our children and we're paying them out of sole proprietorship. And they don't pay federal income taxes because they're under the federal standard deduction. So it's a way to do that. And as a parent, we know that we're always supporting our kids. But what if there's a way that now we can move that after tax spending? We're going to send them to a basketball camp or a volleyball camp or an amusement park with friends. And typically we're going to do that no matter what. But instead of paying after tax dollars, what if we found something that they could do in our business? We pay them a reasonable rate for the work that they're doing. We get a business deduction. They pay no income taxes on that. And now we just shift that spend that we are going to do anyways from after tax spending into pre-tax spending. But I think, Carl, the important thing to understand is this doesn't just mean that, oh, yeah, I'm going to air quote, hire my kids, pay them $15,000 a year and move on from it. No, your kids have to be doing actual work in your business. They need to be paid a reasonable rate based on their experience and what they're doing. So we can't, if we're going to pay somebody $60 an hour to mow our lawn, we can't pay our kids $60 an hour because likely they're not going to be as advanced as, say, a professional lawnmower. So we might pay them $30 an hour or $25 an hour for whatever means based on their age, their experience, and what they're doing. But if we can find legitimate work that they can do in our business, track the time, pay them a reasonable rate based on that work, file a W-2 at the end of the year, this can be a super, super powerful strategy. And again, it's one of those strategies that I say every business owner, if you have children, should be taking advantage of this in some way. Now, some people might hit the $15,000 or more in income that they're paying their children. Others might pay their children $1,000 or $2,000 a year. Whatever it is, find something that they can do in their business. And I talk about this often with business owners. You don't know how many people have come to a meeting with me and said, there's nothing I can do. There's nothing my kids can do. I'm an attorney. I work from home. I don't advertise. I don't do anything. There's nothing the kids can do in our business. And then we start to dig a little bit and we say, well, I know you based your entire law practice based on referrals only, but what if we put up some social media? Is it really going to hurt your business by having a social media presence that your kids run? And they're, of course, like, no, that can't hurt my business. I don't need it, but it's not going to hurt my business. Let's start thinking outside the box and finding opportunities to take advantage of a strategy like that.
That's good. Now, Mike, when you're hiring your kids, are there any compliance pitfalls that you need to watch out for?
Yeah, the biggest thing is if we talked about an S Corp earlier, and so the biggest thing is that if we're paying them out of an S corporation. Now, I mentioned that if we pay them out of a sole proprietorship, we don't need to withhold FICA taxes. They're not going to pay federal income taxes if they're under the standard deduction. If we pay them out of an S corporation, we definitely need to still withhold FICA taxes because it's an S corporation, not a sole proprietorship. So oftentimes we'll do a workaround and have one entity of ours be a sole proprietorship that does services for our S corporation, or maybe we have a rental property that's set up as a single member LLC or a sole proprietorship and we're doing it that way. But that is one thing to be thinking about. We also want to make sure, again, we have full documentation of what are our children doing. What are the hours? Do we have a timesheet? What hours are they putting in? What are we basing the rate that we're paying them off of? And documenting that to its fullest extent, and then also issuing them a W-2 at the end of the year. Now, that W-2 is not going to have much information on it. It's going to say, we paid them X amount. There was no taxes here, no taxes here, no taxes here. So it's going to be a very basic form, but still a form that we want to file just to make sure we're compliant in that aspect.
Good. Now, when we're looking at all of this process, there's learning and then there's implementation. And so entrepreneurs love to learn. They love to go to conferences. They love to read books. They're listening to podcasts. They're always absorbing information, always students, but they don't always execute. And so what's the cost of not acting on tax planning strategies and insights?
Yeah, the thing I always say is the cool thing about tax planning is that it can guarantee results. If we're going to put a marketing campaign into our business, and not saying that we shouldn't, we definitely should be doing that. But if we put a marketing campaign in our business, there is no guarantee of the results we're going to get in that. We can't spend $5,000 on marketing and guarantee we're going to see $15,000 in revenue. Because if we could, everyone would do that, right? Who would not pay $5,000 in marketing to guarantee $15,000 in sales? Everyone would do that. But the cool thing about that is that in tax planning, we can guarantee that. I can guarantee that if you hire your kids and you pay your kids $15,000 a year, I can guarantee based on your tax rate, the exact savings that you're going to get from that. And so that's the cool thing about tax planning. But you're right. So many business owners stop at the learning aspect. And I fall victim of this too. I'm listening to podcasts on different topics and get to a point where, oh, that's a really good idea. And all of a sudden I drop the kids off and go get a coffee and start my day in my office, and that great idea that I thought would be good for my business is out the door and completely gone. So that is that concept of learning without implementation. And so learning is great, something you need to do, but if we don't implement it, there's no results. There's no tax savings from it. And so oftentimes I tell business owners, what I do is I have a note in my phone. And anytime I hear a podcast, I read a book, I hear something that's relevant and really good for my business, I put a little note on my phone that I've read about this to come back to. And then once a month, I block out a half a day on my calendar. In that half a day, I go to my note app on my phone and say, okay, what were some of those things that I thought would be really good for my business? Now I can take that time to actually implement it. And the other thing with implementation is it's not just implementation, but correct implementation. And this is key, especially when it comes to tax planning, because you can take a strategy that is black and white legal in the tax code, and you can make it illegal by simply not implementing it correctly. So I always say we want to learn first. Of course, learning is good. Then we want to not only implement, but we want to implement strategies correctly, making sure we're dotting our I's, crossing our T's, have the documentation on file to take advantage of what's readily available to us.
Excellent. So that being said, Mike, what's one simple move that a business owner could make this week and implement this week that could yield some big tax savings?
Yeah, I think it's taking any one of the different things that we talked about today, whether that is setting up a board, hiring your kids in your business. Those are two moves that are maybe take an hour to 2 hours of implementation that could provide you a guarantee two, three, four, $5,000+ in tax savings, depending on what extent you're doing it on. And so I think it's just finding an opportunity, finding a strategy that makes sense, that is easily to implement, and then getting started on that. Because Carl, I think the other thing too is a lot of people see, oh, Mike's talking about hundreds of strategies that we can implement in our business, right? And that's overwhelming to me. So I'm just going to go the other way because that's way too much. But if we start with one strategy, implement one strategy a month, we'll slowly make our way there, build confidence, and knowing that, oh, look, like that thing really works. That thing really produced some really good tax savings for me. And you'll gain momentum that way. Don't try to knock out 100 tax strategies in 1 month or in one sitting. Work one at a time, start to knock them off, check them off, make sure you're doing it correctly, and make your way towards that ultimate goal of paying the least amount of taxes legally possible.
Fantastic. And kind of to wind us down here, when we talk about taxes and the tax code, one of the things that you talk about often is that we're really looking at incentives from the government, and we need to clarify that using those incentives isn't cheating; it's actually strategy. And so, if you'll kind of clarify that uh, you know the tax code is a series of incentives. It's not just a bill. And can you expand on that? And then why business owners need to not feel guilty about using these strategies to lower their taxes?
Yeah, it's a constant battle that I see business owners run into, and not only business owners, individuals alike. But they say like they prepare their tax return how they normally would, and they say, okay, I owe the government $50,000 in taxes, but if I would have done this strategy and this strategy, I'd only owe them $30,000 in taxes, and they to themselves think that that's cheating, right? Because I owed the government 50 before, but now I did these little things and now I only owe them 30. And so that's cheating the government when it's not that case. The government put these laws in place for a reason and they want people to take advantage of them. But the government is not going to put it on a billboard and advertise it to you. The government is not going to do it for you. The government's not going to say, oh, you didn't hire your kids. That's okay. We'll do it for you. We'll mark your books up. We'll hire your kids for you. The government doesn't do that. So it's our job to understand what incentives are in the tax code for us to take advantage of. And the reason the government puts these incentives in place is because they want something. They want something that they can't or don't want to do themselves. And so if we look at affordable housing, the government wants affordable housing across the country. They want their citizens to be able to live in affordable housing, right? And so, but the government doesn't want to put up all these affordable housing complexes themselves. So what do? They incentivize real estate investors. They incentivize developers to build affordable housing. The government wants, depending on the administration, wants green energy, wants people to be more energy efficient. So what do? They offer tax incentives. The government wants a growing economy. The government wants people hiring other Americans. And so what do? They offer incentives to business owners. And so this is happening all the time. And, I think the funniest one is there's that one big, beautiful bill that recently passed. And one of the pieces in there was something about Alaskan fishermen of some sort, something that got passed in there. And so that it was a tax benefit for them. And that's in there for a reason. They want to incentivize whatever was going on in that area. They want to incentivize them to do that. So if you're that Alaska fisherman that now gets this credit that got created, and I don't know the details just because it's not relevant to enough of my people, but if you're that one person that credit was relative to, it's not cheating by taking advantage of it. Now, what would be cheating would be incorrect implementation, taking something that's in the tax code, implementing it incorrectly and abusing it. So if we take that home office as an example, black and white in the tax code, but now we file a return that says 95% of our home is our home office. That's cheating. That's blatantly taking the tax code and abusing it. And so that's where people get caught. That's where people get caught in cheating. But as long as we know the tax strategy and we correctly implement it, we're just taking advantage of what the government wants us to use, what the government put in place as an incentive to us as a business owner.
Great advice, Mike. And so this has been a phenomenal conversation. So if somebody wants to connect with you, learn more about you and what you're doing, where can they do that at?
Yeah, two places to check out. One is taxsavingspodcast.com, and the other one is a software that we use to help out business owners understand what strategies are available to them, help them implement them, and then be there with them along that journey. And that's you can find that at TaxElm. That's TaxElm.com.
And to our audience, thank you for joining us today on the Digital Insurance Agent Podcast. We look forward to having you on our next episode.